Well,
I'm going to start with something here
yeah.
before you do.
Okay, let's go.
If you're out on the road, you're traveling, I understand it. If you're sitting at your desk and you just don't have your camera on because you don't want to, turn your camera on. I'm kind of mean about that. I understand if you're traveling and you're busy, you can't have your camera on, don't want it on. But if you're sitting in your office, Kim Gindy, I see you there.
I'm laying on the
She,
bed though. Does that count?
I don't care.
All right.
Join the party.
I'm
Perfect.
trying.
Thank you for those that did. I appreciate it. And for some of you, I know you're traveling, you can't have a camera on. I get it, but if you can, please join us.
Matt, can you hear me?
Yeah, well, yes, we hear you, Nigar.
Awesome.
Okay.
All right.
All you,
Well,
Kale.
everybody, yep. As Matt said, let's get these cameras on. Let's see everybody. Yeah, you have questions, save them for the end. Put them in the chat. We'll try to get to them. But if you don't have a piece of paper and a pen ready, this is going to be knowledge central. So be ready to write down everything you got. This is going to help you guys big time in the coming weeks. So Matt is a master when it comes to IULs. I've sat down with Matt quite a bit, talked to him about IULs, and it's just you guys are gonna love what he's about ready to give you. So Matt, without further ado, the floor is yours.
Okay. So, I was building this out for today and I thought, should I make slides? Should I take us through a set training? I've done those for years. But the most successful trainings I've had have been the ones that go where you guys need them to go. In other words, this is audience participation time. We are not going to save questions till the end, but I may table some of your questions that would take us down rabbit holes. Okay. So I do want you to interrupt me. Because if you have a question, somebody else probably has the same question. All right. So we're going to start with that. Now, let me find this document that I had up here because it's really a great document that will help us understand a few things here. Let me find it. Let's see. My documents all went away from me here. I had them all up. All right. This is a document called The Facts of Life Insurance. Um, I saw Ron Roseborough out there. This is built by a company that I don't have access to, but I do. So this is a great piece, and I'm going to share my screen. All right, somebody give me a thumbs up. All right, facts of life insurance. Before everybody got on here, we started the conversation. Somebody asked a great question. Diane, you have a question right away? I saw a hand up.
Okay.
Diana, you good, or you have a question? You had your hand up. Okay. I'm going to lower her hand. All right. So life insurance. We know what life insurance is. We're not going to silly this down
Okay.
to too far down. All right. We know what the
Oh,
basis of life insurance, the reason,
okay.
hang
All
on
right.
here. JW,
All right. Well,
Jane
thank
Go ahead
Walker.
and
you.
mute yourselves.
I muted her. All right. So the basis of life insurance when you're in your working years is to replace your income so your family has money, right? That's the basis of it. Number one reason to have life insurance in your working years is so that your family can continue on. Well, when you get to be late 50s, into your 60s, and into your 70s, does that mean you don't need life insurance? Well, of course you do. Number one, you need to have enough money there to pay your final expenses, right? Whether that's funeral home, burial, final medical expenses, right? Here's one everybody forgets about: transportation for the family to get to the funeral. Right? Your family's all moved away. Maybe it would be a hardship for them to come. You have a few bucks there pretty cheap to make sure everybody's got the money they need. All right? That's number one. Number two, I would like to leave some money to my children, grandchildren, etc. Okay? How is it most efficient to leave that money? Is life insurance more efficient than just an annuity? Number three, here's a big one for you. All right. Husband and wife going through life, and unfortunately, in their 60s or 70s, one of them passes away. And they had life insurance. And lo and behold, they planned well. They tried to get the right amount of life insurance, but they had a bit too much. Because if you did it right, you're going to have a bit too much, because you want to have too much rather than not enough. Right? Spouse gets that money, it's cash money. The conversation goes like this: Mrs. Jones, your spouse just passed away. Very sorry for your loss. We're here for you to help you through this transition. Now, that money that you got from life insurance, what would you say is your number one purpose for those funds? Do you need that money to live on? No. Do you have something you want to buy? No. Would you like to pass that money on to your children or grandchildren? Yes. Then we've tackled the top three things that find the need. The need is to build a legacy. Now we have to tackle the hard part. Is she healthy enough to get it? And a lot of people have trouble talking about life insurance to people in that age group because they think none of them are healthy enough to get it. It is not true. What we are looking for in a 68-year-old female is for them to be in average health for 68-year-old females. Would you say that an average 68-year-old female takes some medication? That's average. That's standard. If they take a bit more and they have some other stuff, they may get table rated. That does not knock them out, especially when we're talking about putting extra funding into the policy up front. We are probably talking towards universal life in these situations because we can fund them how we want to. But I digress. We'll get back to that. Hold that thought. Leaving a legacy. That's a big one. Basic types of life insurance. Why am I talking about universal life more than I am about whole life in these situations? Number one, basic term life and cash value term life. If your client is over 60 years old, forget about it. Maybe at 60, we can do a 10-year. If it's for a specific need, it would make sense. Other than that, forget about it. Once you reach that age group, you're doing permanent life insurance, which means we have whole life, universal life, and indexed universal life insurance. We do not worry about variable universal life insurance. Again, in that age group, nobody has any business owning it anyway. But I would like, when you guys get this document, for you to understand what it is, and here's why. There are some variable universal life policies out there that people have owned for 20 years that have done pretty well. And they have a lot, decent amount anyway, of cash value in them. But here's the one thing every one of those people say when I ask them about it in their 60s. You've got this variable universal life insurance. It's in the market. Are you okay with still having that market exposure? No. Are you okay with continuing your premiums for a few more years? No. Here's what I want to know from that person. How much death benefit do you have? How much cash value do you have? Is it out of surrender? And if I could show you a product that would get you a major portion of this death benefit locked in without ever paying another premium, would you be interested in looking at that? What do you think the answer to that is? Hook me up. Where do I sign? It's the easiest sale you'll make. There's not a billion of those out there, but there's several. How do you find them? You ask. Who do you have your life insurance with? Could we review that? Give you a free review of that? Can we make sure that's going to work for you for the rest of your life? We have experts on staff who would be willing to look at that for you and let you know how that is going to work out long term. Number one question to always ask people about life insurance: A, do you have life insurance? B, who do you have it with? And C, the most important question, when was the last time you sat down with your agent and reviewed it? That's where you upset the apple cart, because they haven't. If they have, great. Occasionally you'll find one that has a good agent and they're taken care of. We're probably not moving that one, are we? Oh, well, get me to the next one. Okay. This document's really important. It tells you those basic differences between whole life, universal life, and indexed universal life. These are the ones you want to know about the most. Here's where I'm going to go with this. The difference between whole life and universal life is that one's an apple and one's an orange. The only similarity have is that they're both fruit, or in this case, they're both life insurance. Everything else about them's different. Whole life insurance, the company tells you how much your premium is, how much your death benefit is, and how much cash value you're going to have every day for the rest of the time you own that policy. There's no flexibility in how much premium you pay, when you pay it, etc. You miss your premium payments, the policy goes away. Universal Life says, we're going to change the whole system here. We're going to tell you exactly what your cost of insurance is inside the policy. We're going to tell you exactly how much our profit is inside the insurance policy. We're also going to tell you that your death benefit can be changed, and we can start it out by building it as an increasing death benefit or a level death benefit. Your premium dollars are flexible, both in the beginning. You can pay extra up front, or you can pay extra later, or you can pay a level amount forever. Or you can pay a level amount and decide that we want to plan to stop making premium payments a few years down the road. It's flexible. We can make it stand on its head and do tricks. That's what makes it a great policy, right? But it also is why so many universal life policies have been built incorrectly over the years. It's why you have to be very careful when working with those. A whole life policy, I call a sock drawer policy. When I buy that, I don't care if I sell you a whole life policy. I don't care if you stick it in your sock drawer and don't look at it. Because I know what it's going to do. As long as you pay the premium, it's going to give you a death benefit, a cash value. We already know what it is. And it's just going to go on forever. A universal life policy is just like the fixed indexed annuity. It's got to be reviewed. Perhaps not every year, but every couple, 3 years, it must be reviewed. Why? Because the illustration tells us what we think it's going to do. It's not a guarantee. It's not a guaranteed answer. There are guarantees in the policy, but we sure hope we're not relying on those. We want it to do better than that. We want to make sure it's doing that. We want to review it. Because it's flexible, we can make changes if needed. What kind of changes? You can change the death benefit. As long as you aren't already at 100,000, you can come down to 100,000. You can always change your death benefit down. With the Mutual of Omaha product, it has a minimum of 100,000, so you can't go lower than that. You can change your premium up or down. Why would we want them to lower their premium? Well, maybe the premium we put in 10 years from now, we're seeing that that's too much. They're overpaying. They can reduce it. But if they're underpaying, we're seeing that the death benefit isn't going to make it as far as we had illustrated. They can increase the death benefit or increase the premium or lower the death benefit, whichever, or a combination of the two to make it work. It's flexible. It's the greatest thing about it. It's also the thing that gets us in the most trouble. So we want to be careful with that. It is super important to build them correctly on the front side so we don't run into problems. We build them conservatively so that the biggest problem I want to see is too much money, not enough. Right? Okay. Also, there's a big difference between universal life, which pays an interest rate based on what the insurance company says they want to pay on it, and that can change, and an indexed universal life, which has a interest rate based on the S&P 500 mostly for what we use, an index, just like a FIA. It's the same chassis as the FIA. Just got life insurance wrapped around it. That's all indexed universal life is. It's a FIA with a life insurance wrapper. You have a FIA inside of it, growing, doing its thing, but when the money comes in, it doesn't all go into the FIA. It goes into the life insurance first so they can pay the cost of insurance and take their profits to the insurance company out. And then whatever's left goes into the FIA and grows. That's an indexed universal life policy in a nutshell. All right, I told you to ask questions. Anybody got questions on that? All right, so the next thing I want to look at, back here, I stopped sharing for a minute. Let's talk about opportunities.
Hey, Matt, real quick.
Yeah.
I'm getting a lot of questions in the chat about that document. Will you be able to send that out?
Yes.
Okay.
I'm going to send it to Jeff Kale. Where it goes from there is not my problem.
I will get it out with the attachment of this video after this call.
How's that? All right. So the next thing I want to look at. This is from another source. This just something I found on the web, by the way. I like it because they put an extra column in here. Let me share it, which makes it easier to read. All right. See that okay? This comes from our friends at Nationwide. I love Nationwide. All right. They created this table. All this is the IRS's RMD table. How many of you think you have a great understanding of RMDs? Well, everybody knows that at an age, it used to be 70 and a half, then it was 72, now it's 73, and in 2033, by the way, it's going to 75. You have to start taking RMDs. Okay? Why? Well, you take RMDs, required minimum distributions, from money that's never been taxed. That's the only monies that have an RMD. So it's traditional IRAs, traditional 403Bs, 401Ks, etc., 457s. Doesn't matter which plan they are in. if the money's never been taxed, they have to start taking it out at a designated age. And how much do they have to take out? So on December 31st of last year, every company that's managing this for folks has to write down how much money people have in their account at the end of the year. And then in January, they have to send them a letter that says your required distribution for this year is X number of dollars, and it's based on their current age, right? So what they say is at age 73, they take that ending amount and divide it by 26.5, which comes out to 3.77% of their account from 12/31 of the year prior must be withdrawn that year. That's not bad. 3.77, it's not that big a number. Till you start thinking about people that have a lot of money in pre-tax. And now they're screaming. Right, Steve Huber? Okay. So 3.77 at 73 is not our issue. What becomes an issue is when you start getting down in here, 80, 81, 82, look at these percentages that you have to take out. Why is that so important? Because you're hitting that break even. You're going to hit that break even that you have to start taking out more than you can earn. So your account value is going to start going down. And that's what the government wants. So when I talk to people who are 72, 73, starting their RMDs, my first conversation is around, look, we're going to talk about RMDs, but we need to have one understanding. In the old days, it was possible to have your children get your qualified money and then they could take it over their lifetimes, and all that's gone. Forget it. IRS said, no, we want our tax money and we want it sooner rather than later. So we're going to increase how much you get to take out every year. And you're going to take more out than you can earn. And if you're still earning more than 5% here, by the time you get to 86 and it's 6.5 plus, you get to 90 and it's over 8. And God forbid you live down here to 95 and you still got a bunch of money in there. They're going to take it. And they're not taking all that money, obviously. You have to take that money out. It's yours. And then pay tax on it. And as bad as that is, there's a worse thing to do with that. The worst thing is if you actually do this and take out, if you have a bucket of pre-tax money that you have basically no intention of spending, and you're at 70, my favorite age is 66 to 72. You're in that age group. You're retired. You know what this bucket of money is earmarked for. It's pre-tax money. You know you have to start taking it out. If you leave it in there and just take out what they tell you to take out because you want to leave that to your kids, you're probably costing your kids tens of thousands up to hundreds of thousands. I've seen one be over $1 million. What? Why? It's real simple once you break it down. You're taking out 3.65% or 3.77% at age 73. Okay? And then paying 15% tax on it because you're in a pretty low tax bracket in retirement. Okay? But if you die and your kids are the beneficiaries and you leave them whatever's still in there, what tax are they going to pay on that money? They're going to pay their own tax rate. Now let's follow this through. The IRS isn't dumb when they did this. You're 73, your kids are in their 40s, right? You get up to 78, 80 and above, your kids are closer to being in their 50s, right? Your kids are in the highest tax rate they're ever going to be in their lives. They're making their money. They're empty nesting. They don't have all the write-offs, and they're making their final money as much as they can to get to retirement, right? I can tell you from personal experience, you're in the highest tax bracket of your life in your 50s up until you retire. So if I inherit mom and dad's money now, I'm going to pay a heck of a lot more tax on it than mom would have paid to pull it out while she was living. Does that make sense? Pretty simple if you think about it. It's just a tax rate trade-off. Do I want mom to pay the tax or do I want to pay the tax? Mom, pay that damn tax. Well, I don't need the money. Well, what if we could put that money into something where you could still pass it on to the kids when you're gone, only it would pass on to them tax-free? But even better is if you need access to it for long-term care or chronic illness, you'd still have access to it first. That's my IUL argument. So the plan I will generally put in place is to tell folks, I don't want you to take out 3.65 and then 3.77 and then 3.92. I'm going to do the math and I'm going to come up with the percentage that we can pull out every year that will stay the same. And make sure that your money lasts long enough to fund this life insurance. Maybe that's 5%, maybe that's 6% of the money coming out every year. Because if I can pull out 6% of this money, let's say it's 100,000. Let's say I can pull out $6,000 a year. Could I get a little life policy for mom? IUL funded for $6,000 a year? Probably so, right? If I take that death benefit and add it to what's left in here after I'm pulling the money out, am I leaving the kids more money after tax? And if I still have a little money here and I have 100,000 over here of death benefit, how much of that death benefit can I access for long-term care or home health care or chronic illness? 80,000, right? 80% minus some fees. It's called 75,000. So if I have 75,000 plus whatever's in here, do I have more money to spend towards chronic illness? This should not be a hard sale. It is, but it shouldn't be. The hardest part about this is getting the client to understand they're not too old to buy life insurance. And it starts with you. Because if you go into it hem-hawing, as we call it, well, I know you probably think you can't get it. And it's no. What you do is you go in and you tell them the truth. We do this every day. I've got people all the way up to age 80 that are buying life insurance on a daily basis. We don't care if you have some health issues as long as your health is still in the range of normal for your age group. Right? But still the biggies are going to stop it. Cancer, heart disease, the big stuff are still not going to allow it to happen. But the ones that do get through underwriting, and they are a really good number of them, I've done some just in this year that I've been with AMBA. I've written some life insurance on 70-plus-year-old people and gotten it through underwriting. Got one back better than standard. It works. And I have a way to show the client with pictures and numbers together to make it a no-brainer for them. I don't want you guys to know every number and how to do all the math today. I want you to, my deep dive into IUL is for you to think deeper about the opportunity. It's not just a burial policy. We have one of those. I have people complain it's too expensive. Great, kick it up to 100,000, do an IUL. Well, it's more money. Yeah, but it's a lot cheaper per thousand. So we have a lot of opportunities here. Death benefit. Our clients are old. If they're not dying, their spouses are. If you have products with a lady and her husband dies, you didn't really have a relationship with him, I don't care. I want you to meet with her, even if we don't have a bit of paperwork to do following his death. It is the number one opportunity to deepen your relationship with your client and to gain new clients. Death benefits are a huge deal, and it's not rocket science. Here's what I offer to people when I'm sitting down and discussing this. Hey, did you get paperwork from some of your companies to take care of getting stuff moved around? Do you need any help with that? No, you don't know how to do that paperwork, but you know it better than they do. And you could help. And you know how to call other companies and ask questions, right? We do that. We can help with that. Don't leave them out there on an island, because the person that throws them the life raft is the one they're going to trust to help them with their needs down the road. Handling death claims for other companies has made me a lot of money. Questions on that?
Kamal, do you had a question in the chat?
I don't have chat up. Not seeing them. Sorry.
He said, would it make sense to use that parentheses or a portion of that money to fund a policy for a grandchild?
Yes. I love IUL on infants, newborns, kids. I think it's the greatest gift you can give to children. And it has nothing to do with making sure there's enough money to bury them if, God forbid, something happens to them in their young lives. That has nothing to do with it. We've all known or all seen young children with awful illnesses, right? Cancers, juvenile diabetes, right? Other unfortunate things that little kids go through. When they were 14 days old, most of them didn't have any problems, did they? They were healthy newborns. Pretty easy to write a life insurance policy on a healthy newborn. 100,000 increasing death benefit costs pennies a month. It's not very expensive. And what does that get them? God forbid they have some issues in their youth, in their teens, even up into their 20s, that ruins their ability to get inexpensive life insurance later. An indexed universal life policy with an increasing death benefit can be increased greater by simply adding more premium. You are guaranteeing their insurability by doing it from day one. I had a grandma with 9 grandkids, popped off 9 policies. We had one decline out of those. Kid had already had some issues. We had to fund some other equal type of funding so that kid had something. We did that through investments. But life insurance is so easy on that. Grandmas are your number one source for buying kid life insurance. Here's another one. I've got a grandma. She's not healthy. Wants to pass money on. Well, Grandma, do you want to pass the money to your kids or to your grandkids? Well, I'd much rather pass it on to my grandchildren. Ding, 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 ding. Well, Grandma, you could own a life insurance policy on your kid that pays out a death benefit to your grandchildren. They'll get that money later, but it's the best way to ensure that your estate is skipping a generation. And you can write a lot bigger policy on the child than you can on grandma, even if she was healthy. So that fights inflation of the kids getting the money later. That's one method of leaving money and skipping a generation. The big key to life insurance is that death benefit being tax-free. Why in the world, since everything else is getting taxed, why are death benefits on life insurance still tax-free? Anybody know the answer to that? How does every person in Congress pass their money on to their kids? Life insurance is not going to get messed with. Every time somebody brings up putting a tax on death benefit, it gets shot down immediately. You will never get a majority to vote to do that. I don't think. They do a lot of crazy stuff, so I guess I could be proven wrong on that, but I don't see it. That crazy stuff they do never seems to hurt their own wealth. This one would. Questions on that? Okay.
Let's look at some of the chats in here.
Yeah,
Matt.
go ahead. Read them off.
Okay, Donovan asked, my client yesterday has a universal life policy bought back in 1988 for $50,000. She did not have a recent statement and has not touched it since that original purchase. What questions do I need to ask once she gets an update on the policy?
Right. So once you get the statement, we want to look at a couple of things. We want to look at what the cash value is, what the premiums are. Premiums probably aren't that expensive, right? But because life insurance premiums tend to go down over time, it is very possible with a universal life policy that I could take that cash value in a one-time payment and get them more death benefit and stop paying for it. I've done it multiple times. You get an old policy somebody doesn't want to keep paying on. Don't call somebody and have them buy your life insurance. No, call us and let us get you a new life insurance with more death benefit and no more premium. Now, does that work every time? No, but it works more than you'd think. You can fund universal life with 1 payment, 2 payments, 3 payments, 5 payments, 10 payments, rest of my life payments. Now, if you fund it in 1, 2, 3 payments, you're going to have a guaranteed to be what we call a mech. Oh no, it's going to mech. Is that bad? Depends. If you sell a policy to a newborn and it mechs, I'm going to tell you that's really bad. If you sell a policy to somebody in their 60s, and we'll explain mech here in a second, and it mechs, it's generally not a big deal. What is a mech? MEC is MEC. It stands for Modified Endowment Contract. So I'm not going to go super deep into this. We're going to be out of time. There are 2 taxability rules on the cash value and the structure of life insurance. One is called the definition of life insurance. It's been around a really long time. I mean, 1930s, 40s, I don't know, forever, as far as we're concerned. Definition of life insurance says there's a maximum amount of dollars you can put into a life insurance policy. Okay. It was the IRS's ability to control how much money we're turning into tax-free death benefit. All right. And a way to control how much money people put into life insurance that they could later pull out without paying tax on it. All right. Well, that wasn't good enough. So later, much later, 80s, they came out with modified endowment contract that did not limit how much that original amount of money you could put in, but it said, we're only going to let you put in X amount every year without turning it into a modified endowment contract. So you have to still pass DOLI, definition of life insurance, but we're also limiting that on an annual basis. And if you go over that at any time, the contract becomes modified, which turns the cash value into a non-qualified annuity. Think about that. The cash value in that life policy is now technically a non-qualified annuity. What's that mean? Well, for withdrawal purposes, what it means is if you're under age 59 and a half, you get penalized. When you pull the money out, you have to pay tax on the gains. When you borrow money from the policy, you have to pay tax, even if it's a loan. Does not change the death benefit being tax-free. It only affects pulling money out. So when I say it may not be a big deal, do you plan on using this cash value in the life policy, or are you just using this for death benefit? Well, I'm not going to touch it. It's for the death benefit. Then who cares? But I won't use that same line on somebody that's young in their 20s, 30s, or even 40s, because they don't know if they're going to need to dip in there and use that money, right? And I'm not going to take that away from them unless they can I make the client make a case for me to do that, because I think it's terrible. I see kid policies that are endowment contracts all the time. I think it's awful. Now that kid's in their 20s, 30s, this life policy doesn't suit them anymore. They want to pull the money out. And guess what? They can't even move that money to a new life policy without paying the tax and penalties first. So yeah, modified endowment contract could be very bad. It can also be no big whoop. Depends on the case. All right. Does that answer
Got
some
2
questions?
more. Yeah. Got two more.
Keep going.
Okay, Nancy asks, she has someone 55 looking for wealth accumulation. How would you structure it?
I am not a huge proponent of using life insurance for wealth appreciation for myself, for the insured. Why? People ask me this all the time, and I have the same answer every time. Okay. Life insurance, whole life, term life is life insurance. You pay a premium, you get a death benefit. We don't talk about cash value as much in those. Universal life is where we talk about the cash value. But the cash value is not the primary reason to own universal life insurance. It's the and. It's still life insurance first, which means you have to pay for the life insurance. So if you're looking to accumulate wealth and you put money into a life insurance policy, we're pulling a chunk of that out to pay for the life insurance, right? If you take a chunk of money and put it into an annuity or an investment or anything else, there's fees, but they're not equal to the cost of life insurance, right? So what you need to think about is, for wealth accumulation, are you trying to accumulate death benefit or are you trying to accumulate cash for later? If you're 55 years old and trying to accumulate cash for later, that's not life insurance. There are plenty of people on the YouTubes and the TikToks that will tell you, well, you can do that. You can be your own bank. Don't believe it. That's a scam of all scams.
Okay. Nygar asks, your opinion on trust.
Well, that's a completely different topic, has nothing to do with life insurance. But if you're asking, should life insurance be put inside of the trust? The answer for me, in most cases, is no. There are certain cases where I will change my answer. Life's a box of chocolates, right? Everybody's got a different situation. So if we need to get even the cash value of life insurance out of your estate for a specific reason, you can put it in a trust. But other than that, there's no reason to put life insurance in a trust. Why do I say that? A trust is designed to make passing money on more legitimate. Now, the trust can be the beneficiary of life insurance. That's a different conversation. But the trust owning the life insurance, I'm not a big fan of that. Let's just leave it there. I can go deeper if needed.
Hey, Matt, I had a question on, came across a gentleman, he's about 73. He's got like a 88,000 in cash value and an IUL, and the death benefits 100,000. So of course, when he passes, that cash value goes back to the insurance company. So are those cases just a case that it was way overfunded? They were paying too much premium and the agent never told him to.
Yes and no. So chances are he did overfund it some. That's not necessarily originally the agent's fault. They ran the illustration. Here's how much you should put in. He did, and it grew. Here's what I would suggest for him. Is he healthy?
Yes.
Then would he like to see that 100 go to 200 approximately? Would that be okay?
Probably.
And would he like to stop paying premium?
He's going to say yes.
Make an appointment.
So then use some of that cash value dollars into a new.
It's just like an annuity. Here's the rules on it. A life insurance policy is non-qualified 99.9% of the time. Non-qualified. Think of it like a non-qualified annuity. So you can take that cash value and 1035 it to another life policy. You can also 1035 life insurance to a non-qualified annuity. Just as you can 1035 a non-qualified annuity to a non-qualified annuity. But there's one thing you can't do. You cannot 1035 from a non-qualified annuity back to life insurance.
So if we did that, you know, if you took a lot of that cash value out of there that has built up into a non-qualified FIA, for example, just leave enough in there that he's not going to run short essentially and start having to pay more
Well,
premiums.
no, you can't do that. They're not going to let him do that. So when you make a withdrawal from that, even to move it to a non-qualified annuity, they're going to reduce his death benefit dollar for dollar.
Okay, gotcha.
What he can do is we can run an illustration for a new IUL and say, hey, if I dump 88,000 in as a one-time payment, how much death benefit can I get? And that number is going to, for him at 73, if he's healthy, 175 to 200 maybe. Maybe. Depends on his health. One-time payment, 1035. And because it's a 1035, there's a chance, I won't guarantee it, I have to look at the numbers, there's a chance that that cash value does not mech and he still has access to it if he needs the cash.
Gotcha. Thanks, Matt.
Yep.
Got some time. A few more questions if anybody has any.
Great questions. Come on, give me some more. Love this stuff. You guys know I Jones on answering this stuff.
So Matt, once I find out some more information on the client, once you get to that cash value and everything, do I just give you a call and say, hey, look, this is what I'm looking at, and then you can advise me what I could do from there?
Yeah, you can generally make 2 appointments for me. One's a half-hour annuity appointment, one's a 1-hour annuity appointment. You
Okay.
look at that and decide, do I need a half hour? Do I need an hour to talk to Matt? And you schedule one of those and put in the notes what we're talking about, and I'm good with it.
Okay, sounds good. I just didn't want to take a fee appointment if that was the case, but I appreciate that. That'll
Well,
work.
you can't take one that's already made because it won't let you have that slot. So first come, first serve. Ask Jeff Kale.
Hey.
Or Steve Huber.
Yeah.
Huber's pretty good about eating up my lunch hour for these things. Now, I would like to, let me see, Huber's on here. We've done life insurance. You got anything to add, Steve, on how this process of universal life works without getting too deep into the minutia of underwriting? What's your experience on the process from the sales side?
First and foremost, call Matt. This guy, ever since he's come on board and he's not paying me, this guy has taken me from an idiot to maybe an idiot walking. I'm still an idiot, but Matt is seriously absolutely phenomenal teaching. I mean, you want to learn, just pay attention to him. You will learn. He took me from what I thought I knew about life insurance to, I mean, 101 to probably 401 within 6 months. I mean, he's great. But from our standpoint as an agent, the key things that I've learned from Matt is, you know, when you're dealing with life insurance, he gave me the acronym LIFE, and it's sitting right here. You want to know what their liabilities are, their income, final expenses, and everything else. And that kind of gives you an idea of, well, how much life insurance do I need? When it comes to the processing, first thing I ask everybody is, what's the purpose of the life insurance? Once you know that, then you can go back to Matt and go, this is what they've got. This is what they want to do. Can you help me design something? And that's the key thing, is knowing that. Now, when you're taking the application, once you get into that, after you're dealing with Matt, he runs the illustration, you show it, you got to know the doctors. You got to know their medications. You got to call the hospitals ahead of time, find out what authorizations or medical records.
I'll argue with you on that one, Steve. No, you
What?
don't.
Why?
Because you don't have to do the health questions.
Why not?
That's an option.
It is. You know me, though.
If you're a control freak like Stephen Huber, you can do all the health questions yourself. But I, as a rule, don't do them if I don't have to.
Then who does them?
Mutual of Omaha, or
There,
actually, it's you.
there's
It's
there,
their
there's your mistake. You
apps.
never give up that
Apps does them,
control.
or Mutual of
Don't give up
Omaha.
that control. I'm telling you right now, do not do it. Because what you can do in one 30-minute session with that client will take them weeks. So if you don't want to frustrate your client, do it all yourself on the application. They're willing to answer the questions. Matt and I will differ. I do not give control to a third party to do what I can do and mess up my client.
Everybody will go at that the way they want to.
Yes.
And I'm okay either way.
Correct.
But I will tell you this, if you are going to handle the health question side of this, understand you've got to do it from start to finish. There's no getting in the middle of it and going, ooh, I don't like this.
No, that is exactly right. And that's why I said with me, I ask the questions, I call the hospitals, the doctors, I get the medical records authorization, I have them sign it up front. So when it gets submitted, it all goes. And that will speed up your process.
All right. Anybody
But
else
key
have any
number one,
questions for us?
listen to Matt. He will teach you any and everything you want to know, honestly.
I have a
He is
question,
by
Matt.
far the best person
yeah.
that has taught me.
Nancy.
Yes, sir. Hi, Matt. So my question is, if I have a 72-year-old male who married later, he moved from his main teaching career in New Mexico, then to Michigan, now to Chicago, and he's experiencing severe sticker shock in everything, including his housing, his daily expenses,
bet.
all this kind of stuff. And because he's married late, he moved here for his wife's career. So he had just like a small final expenses before he got married. Now he's all of a sudden worried about more life insurance. And he's 72, and I gather that his his cash flow isn't the best. At first he asked me for a term policy. I'm like, why do you want a term policy at age 72? But what thoughts do you have?
So those are always the toughest ones, right? We know he has a need, or he knows he has a need, and we need to dive into that more and figure out what the right amount of need is. Okay. And then before we build anything, I'm want to kind of corner him. I'm gonna say, look, there's different types of life insurance and they're going to serve different purposes, but there's good, better, and best in life insurance. And you get what you pay for. What's your budget?
Yeah, we haven't got into, he's being kind of cagey about that, but what I did sort of present to him conceptually with some help from Mary Martz is an IUL. I mean, here's a guy who was 72, and I asked him, how much insurance are you thinking? He goes, I don't know, maybe 500,000.
But I mean, here's the question. Yes, his cash flow may be tight. What I often find is, even though cash flow is tight, there's another bucket of money somewhere.
Well, I'm about to find out, because what I presented to him conceptually was an IUL starting at 100K, just to throw out that premium amount so he could see what it looked like, and then suggesting that he should fund it with a FIA. And
that's just it. I mean, if I can fund it with a FIA or some other way of funding it outside of his cash flow. So that's the biggest reason they don't want to buy life insurance, is for the same reason they don't want to buy long-term care insurance. I don't make enough to pay for that. Well, then let's not take it out of your income.
Right.
Especially when they're 66 to 72, because they still haven't thought about the fact they have to start taking money next year anyway. Right?
Yeah. Well,
In
if I get
73, he's got to start taking money out anyway.
If I get him to an appointment to actually look at this stuff, I'll get you on it with me.
I'd love to.
Okay. Thank you.
Who else got anything? We're running over, but I'm here.
Nancy, real quick, when you do schedule on his calendar, it could be with the client. If you want a little training one-on-one, I'm sure Matt will do that as well.
Small fee.
Yeah, there's a fee to it. That's why Steven has to sell so much, because
You have to bring me 1 to 3 new FIA clients to go with it. That's the fee. All right, guys. I appreciate you all very much. Thanks for hanging with us. If any questions you didn't get in here, please send them to me. Happy to answer questions or get on my calendar for a half-hour meeting. That's why I put that in there, was for, yes, it says for review appointments, but it's a half-hour meeting. If you need me for something and you can't get a hold of me on the phone, good luck trying. You can try. Just book a half-hour appointment.
Thanks, Matt. This is really nice.
if you think you guys want more of these kind of trainings with Matt,
Yes.
would that be helpful? All right.
Yeah,
I
good
don't
stuff.
think you
I got to
can
go
have-
sell some more FIA to
Yes.
pay for this. So,
I don't think you can have too
Go,
much
Jeff.
of it.
but all right, I'll get the video out. Thanks, guys.
Thanks.
I'll put together a packet for you, Jeff.
Okay.
To me, if Nationwide puts this out on the interwebs, they're okay with us using it. So we're going to
Okay.
use